Welcome back to Talk Tickers. Today we are diving deep into the Q3 2025 earnings call for Nebius Group. This one was held pre-market November 11th.
Yeah, definitely one of the most anticipated calls in the infrastructure space this quarter.
Absolutely. And the results were, well, a study in contradiction, weren't they?
They really were. So our mission today, folks, is to get past those headlines. We want to dissect the strategic moves Nebius is making, especially on capacity.
Understand those huge multi-billion-dollar deals.
Right. And really try to figure out why the market reacted with, well, frustration. Because that immediate share drop, 4 to 7% midday, needs explaining.
Okay, let's unpack that initial results snapshot then. Because it really was a classic mixed bag, like you said. Frustrated the street. So on one side, you have profitability beating expectations pretty handily. Non-GAAP EPS came in at negative 40 cents.
Yeah, much better than the consensus estimate, which was around negative 52 cents. So, they're improving efficiency faster than expected.
But here's the tension. The revenue number. $146.1 million.
And that missed the street's target. Consensus was looking for something closer to $155.1 million.
So about a $9 million gap there. And the market just immediately zeroed in on that miss.
Totally fixated on it. Even though,
yeah, if you zoom out just a little bit, the growth is still phenomenal, right? That $146 million, it's still up 355% year over year.
And 39% quarter over quarter. I mean, those are hyper growth numbers by any standard.
Exactly. And I also noticed the adjusted EBITDA loss, it narrowed quite a bit down to negative $5.2 million.
Right. And their core AI infrastructure business, just that segment, showed real strength. It was running at an adjusted EBITDA margin near, 19%?
Almost 19%. So profitability improving, incredible growth rates.
But what's fascinating, or maybe frustrating depending on your position, is the market basically ignored the EPS beat, ignored the narrowing losses.
All focus on the revenue miss.
The revenue miss, coupled with the financing news we need to get into, it just signals that right now investors are prioritizing hitting those near-term revenue targets.
Execution, basically.
Execution, exactly. And crucially, visibility into how they're going to fund all this growth. That seems more important than the headline profit metrics at this moment.
Okay, so it sounds like they're getting credit for the massive potential, but dinged hard for the speed of execution right now.
That's a good way to put it.
But if they're selling everything they can make, how does a revenue miss even happen? Especially when profitability is improving.
Well, that takes us right into the core theme from management on the call. Sold out capacity.
They really hammered this point home.
They were crystal clear. Said revenue growth was limited only by the physical capacity they could actually bring online, period.
They even mentioned learning to say no to customers, right? Turning away business.
Yeah, learning a new skill, they called it. Which, on one level,
that's the ultimate validation of demand, isn't it? It's fundamentally a supply problem, not a demand issue.
Absolutely. And you see that reflected in their pipeline numbers, too. Pipeline generation expanded 70% quarter over quarter.
Wow.
Generating something like $4 billion in potential deals in Q3 alone. It just reinforces this picture of overwhelming, just massive demand.
And that overwhelming demand, well, it connects directly to why these huge customers are locking them in for the long haul.
Exactly. Which brings us to the new marquee deal they announced.
The Meta deal. 5 years. Roughly $3 billion for AI infrastructure.
A huge validation. And you have to remember the context here, the existing mega deal with Microsoft.
Right, valued somewhere between, what was it, $17.4 and $19.4 billion.
Just enormous figures. These deals really cement Nebius as a strategic partner for the hyperscalers, not just, some commodity compute provider.
Okay, but here's the rub, right? The deployment timeline. Investors care about when that cash actually hits the P&L.
Always. And management was pretty upfront about this. For the Meta deal, deployments are expected to ramp up to the full revenue run rate mostly in 2026.
So not next quarter.
Not next quarter. And for that massive Microsoft deal, the revenue ramps throughout 2026, but doesn't hit the full annual run rate until 2027.
Okay, so that requires significant investor patience, something the market clearly didn't have much of on call day.
Precisely. And that timeline, it introduces execution risk, doesn't it? They have to secure the funding, build the physical infrastructure years before that revenue fully materializes.
Which brings us to how Nebius is trying to build a moat, trying to be more than just raw compute. And this is where it gets really interesting, I think. They're moving into the platform space.
Definitely. They launched Nebius AI Cloud 3.0, codenamed Aether, and this is aimed squarely at large enterprises.
What's key about Ether?
Compliance, that's the big thing. SOC2, IPay, ISO certifications. For you, the listener, this is critical. It means Nebius is climbing the value chain.
So getting high PA compliance, for example, opens up healthcare, finance, these big risk-averse industries.
Exactly. Industries that wouldn't touch a provider without those specific certifications. Compliance equals enterprise trust and usually higher margins.
And it wasn't just Aether, right? They also launched something called Token Factory.
Yeah, Token Factory. This is a production-scale inference platform.
Okay, so inference, running the models daily, not just training them initially. Why is that significant?
Well, inference is where the sustained volume is and where enterprises need predictable performance and cost. Token Factory lets them run popular open source models, Llama, Falcon, Mistral, you name it, with guarantees.
Performance guarantees and transparent costs.
Right. See, just selling raw compute for training, that can become a commodity game. But selling a platform for inference, for daily operational use, that builds sticky revenue. It feels more like software.
So this shift from just capacity to platform, that's the long-term strategic play here.
Arguably the most important long-term narrative for Nebius, yes. It's about defending margins and building a stickier customer base.
Okay, so with all this demand, these big deals, this platform push, how does this translate into future value? What are they guiding towards?
They put a huge stake in the ground. Management is aiming for $7 to $9 billion in annualized run rate, ARR, by the end of 2026.
7 to 9 billion by year-end 26? That's ambitious.
Very ambitious. But here's the kicker. They stated, pretty confidently, that more than half is already booked.
More than half booked already. That provides a stunning level of visibility, assuming
Assuming they can execute the build-out, exactly.
which hinges entirely on getting that physical capacity online. What are the latest targets there? They updated those, right?
They did, and they're accelerating everything. The contracted power target, so securing the land and power rights for the future, that's now over 2.5 gigawatts by the end of 2026.
That's up from 1 gigawatt previously targeted.
Way up from 1 gigawatt. But the number to really watch, the critical metric, is connected power. That's the fully built-out data centers ready to go.
Got the target there.
They're aiming for 800 megawatts to 1 gigawatt of connected power by the end of 2026. Hitting that goal is the absolute measure of success for the next 2 years.
Okay, so capacity is the bottleneck, and capital is the fuel to break that bottleneck.
Perfectly put.
And Nebius is clearly hitting the accelerator on spending that capital. The 2025 CapEx guidance, it was dramatically raised.
Dramatically. From around $2 billion previously, up to circa $5 billion for 2025.
$5 billion in 1 year. Just wow. And that's going towards GPUs, power, land, accelerating everything.
Everything needed for that capacity build-out. It's an unprecedented pace of investment for them.
And you see that burn rate reflected right there in the Q3 cash flow numbers. Cash from operations was a loss of $80.6 million.
And CapEx itself was a loss, or rather outflow, of $955.5 million just in Q3.
Nearly $1 billion out the door on CapEx in 1 quarter. This aggressive spending, this front-loading of cost, that's clearly what's making the market nervous.
Understandably so, though management did provide a really helpful breakdown of that CapEx, which I thought was interesting.
Oh, yeah. How did they break it down?
They said it basically happens in 3 stages. Only about 1%, just 1%, goes to securing the land and power rights initially.
Okay, that's surprisingly low for the first step.
Right. Then about 18 to 20% is for building the actual data center shells and connecting the power infrastructure.
So the physical buildings and grid connections.
Yes. And the remaining 80%, the vast majority, is purely for deploying the GPUs and the related networking gear inside those data centers.
80% on the GPUs themselves. That's a huge chunk.
It really highlights the cost structure.
But hold on, if only 1% is needed up front for land and power, the critical long lead time items, why aren't they allocating more now to lock up even more future sites, maybe looking beyond 2026?
That's a really sharp point. They are focused on securing that land and power aggressively now to de-risk the current plan. But the reality is the sheer dollar amount, 80% of the CapEx, is tied to acquiring those GPUs when the buildings are ready.
So the biggest financial hit is closer to when the revenue starts.
Yes, but it also means their execution risk isn't just about permits and construction. It's a massive supply chain risk. They are utterly dependent on getting their hands on these high-demand, very expensive GPUs on time to actually monetize the infrastructure they're spending billions to build.
And that dependence on GPUs, which cost a fortune, brings us right back to the immediate capital need, funding that $5 billion CapEx plan this year. That's the core issue driving the stock's reaction, isn't it?
That's the elephant in the room, absolutely. They need the cash now.
How are they planning to get it?
They confirmed it'll be a mix. They'll use corporate debt. They'll use asset-backed financing.
Which is smart, leveraging the creditworthiness of Meta and Microsoft.
Exactly. That's generally seen as attractive financing. But the third piece is equity.
And that's where the market flinched, the equity component.
That's where the stock really took the hit. Management confirmed they are filing for an at-the-market equity program, an ATM program.
For up to how many shares?
Up to 25 million Class A shares.
25 million shares. Okay, so for listeners, maybe unpack what an ATM program means versus a traditional offering.
Sure. So unlike a big one-time secondary offering where they sell a large block of shares at a fixed price, an ATM allows the company to sell shares gradually, sort of trickling them into the open market over time at whatever the prevailing market price is.
So it gives the company flexibility on timing and price.
Yes, much more flexibility.
But the market hates the uncertainty, right? That potential overhang of shares that could be sold at any time.
Precisely. Management stressed they would remain dilution sensitive, try to use it sparingly, only when needed for the CapEx.
But the authorization is there. 25 million potential new shares.
And that creates this cloud of potential dilution. It acts like a cap on the stock price in the near term, almost regardless of how good the underlying story is.
Even though the stock had that massive run-up, what was it, 234% over 6 months?
Yeah, incredible run. But the market is penalizing the need for this flexible funding now. It's the immediate capital requirement clashing with dilution fears.
It's that classic conflict. They absolutely need the money to deliver on the huge $7-9 billion ARR plan.
Which is what long-term investors want to see.
But the very act of raising that money via equity hurts the share price today.
Wow, it really forces investors to make a judgment call. Do you trust management to, as they say, thread the needle, fund the growth efficiently, minimize the actual dilution from this ATM? Or is this the beginning of a cycle where they constantly need to tap the equity markets?
Tough question. Okay, well, that sets the stage perfectly for our next segment. It's time to put on our imaginary investment committee hats for This Is Not Financial Advice. Remember, folks, seriously, this is not financial advice. Just a thought experiment.
Right. So the thesis here really hinges on that divergence we just talked about. The market seems laser focused on the short-term stuff, the small revenue miss, the 25 million share ATM overhang, just noise potentially.
Well, the actual long-term story.
The 2026 story. That $7 to $9 billion ARR target, backed by billions already booked. The clear roadmap to over 2.5 gigawatts of contracted power. That story is incredibly strong. There's a fundamental disconnect right now between that potential and the current stock volatility.
Okay, so based on that divergence, what's the outrageous but plausible trade pitch?
The pitch is essentially a highly leveraged bet on execution, the idea. Buy deep in the money call options, but give yourself time. Look out 18 to 24 months for the expiration date. Okay,
so long-dated, deep in the money calls. Why that structure?
It's a leveraged way to bet that Nebius will execute, that they will hit that $7-9 billion ARR target by end of 2026 and successfully turn that massive backlog and contracted power into real revenue-generating connected power, more or less on schedule.
So the logic is, treat the current 4-7% stock dip as just short-term market indigestion.
Nice. Exactly. Because the long-term valuation driver for this company won't be this quarter's revenue variance. It'll be whether they successfully deployed that massive capacity ramp they're building right now.
And by using long-dated options, you're essentially betting that management navigates the financing challenge smartly.
Right. That they use the ATM judiciously, lean on the debt and asset-backed options, and ultimately fund the growth without crushing the share count too badly by the time we get 18-24 months out.
When those big Meta and Microsoft deals should really be hitting their stride in terms of revenue recognition.
Precisely. It's a conviction play. You're saying the short-term funding pressure is actually creating a long-term buying opportunity amplified through options.
High conviction, definitely high risk, a pure play on management's ability to execute a multi-billion-dollar infrastructure rollout almost perfectly.
Couldn't have said it better myself.
Okay, so let's wrap this up. What does this all mean for you, the listener? Nebius reported undeniably robust demand, They secured that massive new $3 billion Meta deal.
And they're aggressively accelerating their build-out, targeting that huge $7 to $9 billion ARR number by the end of 26. Huge potential.
But the cost of that acceleration is immediate and painful for the stock price right now. You've got the Q3 revenue miss, the massive jump in 2025 CapEx to $5 billion.
And the introduction of that 25 million share ATM program, creating the dilution overhang.
So the big picture takeaway.
I think the multi-year story for Nebius is this pivot. They're trying to move from being just a capacity-constrained, hyper-growth company, basically selling compute shovels in an AI gold rush, towards becoming a platformized AI cloud at scale, adding value, adding services, building that moat.
And the critical question for investors.
It really boils down to this. Can Nebius manage the twin risks? Can they handle the potential dilution from funding this massive build-out while simultaneously executing perfectly on converting that huge contracted power backlog into actual high-margin revenue on time?
If they pull it off.
If they execute efficiently against those aggressive capacity goals, the revenue will follow, given the booked business. And if that happens, the market could quickly re-rate the stock and reset expectations much, much higher than where they sit today after this earnings reaction.
So the next few quarters are really about logistics, aren't they? Proving that construction and deployment teams can move just as fast as the sales team has been.
That's the challenge. Execution is everything from here.